welcome and thank you all for joining us. We created a recording, so in a moment or so, I'll stop talking, then we'll switch over to the video. This is a unique investment in a couple of different approaches, in a couple of different ways. First, it's different because it's a project that Astor owns and owned for the last 3 years. Secondly, most of the projects that we do, as you all know, are typically ground-up project. This is different. This is an existing project. At this point, almost fully stabilized. We're about 85+% occupied. These are 205 existing apartment building that we've acquired. It's a blue-collar type of a community that we acquired in March of 2022. Ultimately, we are managing this project for the last 3 years with some local partners, but we are taking the reins on this project. When we took the project, it was quite frankly in shambles. We spent a good amount of money. It looks great now. We've created a fantastic community, and we'll talk more about it. We'll talk more about Texas in general. This is truly one of the strongest markets, Dallas-Fort Worth. It's a market that's shown a lot of growth. It's my favorite second market, as you know, immediately after South Florida, but nonetheless, that represents a growth market and a very, very solid one as well. And so without further ado, I'm going to ask you, Alex, please put the recording. We have a 205 apartment complex that was acquired some 3 years ago with ourselves and some other partners. Over the last 2 to 3 years, we've worked very hard, pulled up some capital into the project, made sure that the project is stabilized. I'm happy to report that we're finally at that stage. We're somewhere in the mid-80s to upper 80s%. We're at the eye of stabilizing somewhere in the mid-90s, low to mid-90s% occupancy, and sort of like effective occupancy, the low to mid-90%. And at that stage, we'll be far away from where we started, where the asset was in shambles, and that's essentially why we bought it. It's a value-add project, and we'll look out to a better future until such time that we can sell the project. It's hard to say when the market will fully calibrate. We're already seeing the right type of movements. We believe, as the market does, that drops in interest rate is imminent. It will sometimes happen throughout the rest of 2025. Certainly, there's good aspiration that rates will drop in 26, and the correlation, of course, between interest rate dropping and asset values going up is essentially what we're looking for. And so in this project, we're projected almost a 22% return, 21.7% return that is net to you, the investor. And we have something that is quite unique, and that is depreciation income. I'm saying it's unique because for those that have been with us in the multiple investment that we've done, 38 to date, investment that we've done over the course of the last 10 years, God bless, we've made a lot of money, we made a lot of profits, but with it comes obviously the burden of paying taxes. In this particular case, we have the option to reduce a significant part of your tax burden on what we call qualified income. We'll go a lot into it in the next few minutes as we go through the slides. So again, for those who are here, this is a 205 unit complex, 1972, circa 1972, blue collar, in a suburb of Dallas, Texas, between Dallas and Fort Worth. We are going to be raising $1.5 million to go through the last reiteration of this project before we fully stabilize it and change the current bridge financing into a permanent financing. What we're doing here is we've changed recently and onboarded in the last 6-7 months a fantastic management company that manages close to 1,400 units. We're very happy to work with them. In fact, they are adjacent to us, the next 3 projects on the very same block as us. They are the one managing it, and we've been very, very lucky to have them join us. We're talking about a management company that keeps their project at occupancy rate that we're very, very happy with, 97, 98%. So that's quite aspirational. The asset itself still has more upside potential. And while we spent a good amount of money, and we'll talk about it soon, we spent a good amount of money on the project, fixing it, stabilizing it, making it look like it does today. We're essentially still have additional rent growth that we expect to see over the next coming years. Also, ultimately, as I mentioned, we're looking into very nice returns, 21.77. And that's those of you who've been investing with us understand we're making those returns, we're projecting those returns based on today's market conditions. So I want to be clear about it. We're projecting those returns, those net return to investors on an annualized basis based on today's market condition. You don't have to be a big real estate maven and a big real estate professional to understand that market conditions right now are soft. And so when we look out to the future, we take no account of market conditions getting better. We all believe they will, but assuming that things stay exactly the same, this is what we're looking at. And then, of course, the depreciation income. As I mentioned earlier, we're having an opportunity here to reduce some of the tax burdens that's created by creating all this passive income to our investors. And it's quite significant. We have an example that we'll talk about later. The location, as you know, we love Dallas. It's one of the strongest markets in the United States. We love Texas. We love specifically Texas and all those areas surrounding Texas. So here we are sort of like in a midpoint between Dallas, Fort Worth, two major employment nodes, very, very significant MSAs. And that's essentially where the project is. And that's sort of like appeal to the blue collar. But guess what? Nobody's building new blue collar units. Everything that's being built is typically very expensive, very lucrative. And so, as those projects get outdated and some of them are phased out, having a blue collar project that's able to offer essentially individuals apartments, 2-bedroom for $1,400, 1-bedroom for $1,100-1,200 is sort of like, a good commodity these days, and obviously a great hedge against any sort of changes in the economy. I want to change over to Andrew, as he's going to be talking about an example. What does it look like to invest $100,000?
Thank you, Joe. So here you'll see examples for $100,000 invested. I'm going to take you through this here, and you'll notice there are 3 columns. These are each based on the potential year of exit, right? So 2028, 29, and 30, which would be 4, 5, or 6 years into the project. Okay, so this investment is based, again, on $100,000. You can invest less, you can invest more. The 100,000 is the gross number. There's a 5.5% participation fee and startup costs. What that means is asset management, accounting, tax filings, administration fees, startup of the investment, the legal documentation, all that fun stuff, right, is bundled in at the start. And this serves as the asset management fee for the life of the deal. So your net capital account in this $100,000 example would be $94,500. Based on the year of exit, the allocation of profit based on your ownership percentage, you can see here. There's a minimum return hurdle of 10% per year, right? So your investment times 10% times the number of years in the project. That's the minimum hurdle before Astor would be able to share in your success, right? Take a promote, which is 25% of the net available profit, right? But that does include a full catch-up, okay? So you have a minimum hurdle, plus you have a net promoted profit. You can see that here in the profit breakdown summary, again, based on 4, 5, or 6 years on the potential deal. What does that mean to you ultimately in the returns, right? We're returning the net investment. We're distributing out this profit to you. That could be anywhere from 178 to 242. The presentation throughout focuses on 5 years, so that's where you'll see the 21.77 net annualized IRR, right? So 208,000 of distribution, right, which is 108,000 in profit. The 2.1x multiple on the investment, which is 21.77%. Net AAR, right? That's average annual return, net of fees, net of promote, and that does not take into account the bonus depreciation which Kevin is going to get into now. As Joe mentioned, Kevin Chow, one of our associates based in Texas, very good with depreciation, very good expert in this. So Kevin, please take it away.
So yeah, depreciation is one of the big benefits that real estate investors like to have. It allows you to save significantly on your tax burden, and we do this by utilizing what's called a cost segregation study. A cost segregation study, experts go in and take a look at a property to see where certain items can be depreciated more quickly, usually to 5, 7, 15 years versus a typical 39-year straight line depreciation. This allows us to defer taxes and increase our cash flows. What we can do with depreciation is it can be used to offset any kind of passive income that you have that year, or you don't have any passive income, or you don't have enough passive income. It can roll over to subsequent years. The biggest benefit with depreciation is that it takes advantage of time value of money. What that means is that rather than paying the taxes now today, you're able to offset that taxes to when we exit the investment, which may be 4 or 5 years from now. So in this example, in this particular investment, you're looking at about $43,000 in depreciation that will be available in year 1, and a little over $3,000 in year 2 through 5. So a total of $58,000 in depreciation that can be utilized to offset any kind of passive income that you have in those years. And again, this is on top of the 21.77% average annual return that you're getting. So with those savings, you'll be able to increase your average annual income above what we projected to have. Now, one thing to take into consideration is that depreciation doesn't eliminate your taxes, it simply defers it, okay? But as everyone says, it is always better to pay taxes later than to pay taxes today.
Let's go back to the business plan. So what it is that we're doing here essentially, we've used a nearly $21 million loan when we've acquired the property. We're recapitalizing right now. In the last 2 years, we had to raise some pref equity. We're recapitalizing the current capital stack, creating a reduction in the common equity that's in the deal right now, raising an additional $1.5 million, and doing a recap of the project to 28.8, or call it almost $29 million. The reason we're doing it, it's because market conditions have shifted. Essentially, we are rebranding or re-pushing new life into this project. And at this presentation, we're focusing exclusively on the new capital that's coming in, analyzing obviously the risk, but also what sort of rewards the new capital is going to have. And so our projection is at the end of this year to reach a somewhat conservative $1.73 million NOI. And at that point, put a permanent financing on this project and either take a 5-year mortgage and sort of like continue riding with the market. We want to be in a position where the market recalibrates. We believe that valuations could go as high as mid-30s, even high 30s. Depends on how long we're going to hold it. And meanwhile, during that period of time, we're going to be enjoying, obviously, depreciation and appreciation of the asset. Over the last few years, we spent a good amount of money on this project. We've built, when we've acquired it, you have a picture of the pool here. The pool was green. I like to say we had the tug pools over there. We recreated the whole pool, renovated many of the apartments, balconies, created a lot of maintenance that was missing, aluminum wires under the ground, above the ground, really literally created beautiful grounds, beautiful areas, and created a community, which we're very proud of. This is sort of like a breakdown of every dollar that was spent over the last several years. You know, the property looks great today. In fact, it's one of the nicest properties to its class, of course, within the area. We're competing very well with all the other properties. And I think our rent is a little bit higher than most. So today in our properties, you'll see church schools coming in middle of the day. There's kids, there's families, there's dogs running around. It's pretty nice. It's pretty pleasant area. We also attacked it not just from a standpoint of physical renovation and increasing the rents, but also from a standpoint of expenses. When we took over the property, expenses were significantly higher by as much as 25 as 30% higher than they are today. We're able to reduce, I think, over $400,000 in unnecessary spends and unnecessary expenses by attacking things like leaks and water, water treatments and all sorts of different things that we're able to sort of like keep things, under a very tight lid and make sure that this is a viable project. Going back to the financials, I'll ask Andrew to continue from there.
So here's a summary of the pro forma. This is what we're projecting to stabilize at by the end of 2025. This does not take any trending of the rent into account. So you'll see the top line income here, $1,350 per unit. Alex is going to go into the rent roll in a little bit, but basically what that is $1,350 per unit on average, right? We have a mix of 1 bedrooms and 2 bedrooms. That's about $3.3 million in gross potential rent. We're planning to add an additional 3-bedroom unit. The clubhouse right now, we can convert that into a 3-bedroom unit. It's not really used today, so we think that'll be a good value add to the project. And then you have other income fees, right? This is your application fees, pet income, parking, some minimal pass-throughs, things like that. Right? So this is just some additional income, about $33 per unit, not a crazy number, which gets us to our $3.4 million of gross income, about $285,000 per month. We deduct from that, especially in year one, which we'll get to shortly, loss to lease, right? That means that we are not charging the full market rent because we are still ramping up to that full occupancy where we want to stabilize in the 95% range. There's some vacancy, right, as we are still having some units that are not rented. And you have an employee unit, you have some concessions, things like that. Renting a unit at a lower amount for 1 month to get a tenant in. So taking all of that into account, that's about 14%, right? Which gets us down to 2.95 million of effective gross income, right? That's what we're actually collecting in our projections, right, by the end of 2025. And then here you'll see our expenses, which, as Joe just touched on briefly, we've made great strides initially, right? So when our expenses we first bought the property, $1.7 million a year, they were a huge drag on our net income. We've been able to make some really good changes from the marketing and administration, utilities, savings on water, things like that. Some of the repairs that we've made have fixed some leaks and things like that. So the property's running very, very smoothly now. We have our insurance and our real estate taxes, so about 1.2 million of annual expenses, just over $100,000 per month. So that's the 1.734 million of net operating income. This is what we have to then be able to pay our debt service on the loan and make distributions to investors. Okay. The 10-year pro forma, which is relevant for you guys, right, as we're looking at a potential sale in this 2028 to 2030 range, shows the progression of the rent. So we have some small growths with inflation there. You'll see that across the gross rent, the 3-bedroom unit, and the other income. You'll see we start to decrease the loss to lease as we're bringing the rents up to full market. We still have carve-outs for vacancy, concessions, in the employee unit, right? Because we're never going to be at 100% fully occupied. That's not really practical. So there's always going to be some amount of turnover there. You'll see where we're able to take the gross income over the years. And then just as we're growing the income with inflation, we're also growing the expenses. Most of your regular expenses were growing at the same 2.5% as the income. Insurance and taxes were actually growing a little bit higher, right? That's something that we've seen in recent years. Those are outpacing some of your regular expenses. So we are actually growing those at a faster pace. So you'll see the total expenses going from 1.2, 1.3, et cetera, getting to our net operating income as we go. And then a little bit more advanced here, but we actually adjust the taxes, right? So the state of Texas adjusts the real estate taxes for the new buyer of a property. So we are taking that into account when we come up with the ultimate sale price of the asset, which, as Joe had mentioned previously, is based on today's market, right? So it's based on all the kind of fluctuations that we've had with inflation and kind of the uncertainty of the past several years. That's based on a 5.75 cap, which could be better. Certainly something we'll hope for, but we think we're being fairly conservative with a 5.75 cap. So, Alex, if you'll take it away, talk a little bit about the current rent roll and where we are there.
Thank you, Andrew. I will talk a little bit about the rent roll right now. We're nearly all leased between the A1 and A2 units. These are our one-bedroom units. I think all but 2 units for the A2 are leased. We're pricing them fairly competitively at just under $1,200 for the townhouse, and then the A2 also just, across all units is reaching just over $1,100. The 2-bedroom units, we have a variety of them split between, a variation of the actual bathrooms. But also here, we're, just overall under 90%, 87.8% we're leased currently. And as Andrew discussed, the targeted rents at $1,350 were just $48 off of that projection as of today. And with that, I think we can go to the next page, the market that Joe will talk about.
So why Dallas-Fort Worth? I'm going to breeze through this part of the presentation. The information is here, and I hope you will be accompanied also by the actual presentation. So you have the video and you have the presentation. But if you look at some of the top markets that Astor has been focusing on, we're focusing on South Florida, we're focusing on Dallas. Other areas we're looking into. There's a couple of other cities that are sort of like up there in terms of positive migration, the type of migration that we like, with deep pockets, professionals, and essentially a workforce that is coming to fill up jobs. That's essentially the areas that we're looking at. We're also looking at something else. We're looking for a specific age average, and in our case, it's 38 years old. And so, the ones that are the 2 cities that are actually we're putting a lot of attention to is Florida and South Florida, all the way from the area of Boca, West Palm, all the way down to Miami, and here mainly Dallas, Texas. We love Dallas, Texas. We've seen tremendous growth, both in employment, tremendous growth in growth of population, and the growth is just continuing, right? There's been a good amount of Class A units that have been built. Those are very expensive units. We like to sort of like offer something that the market is truly as much in demand, and this is essentially this project. So we have a strong market that's booming, obviously very favorable business climate. We're talking about no state taxes. The occupancy levels are very high and continue to grow, and fairly affordable cost of living. So we love Dallas from every major angle. Arlington itself, as I mentioned, sits in the middle of 2 of the centers of employment, which is Dallas and Fort Worth. If you can imagine a line that's connecting, okay, that will be the I-30, Interstate 30. It's about a 45-minute drive between Dallas and Fort Worth. Very beautiful drive, scenic drive. In the middle of that road, okay, sits Arlington. Arlington eventually is a very much a booming city. If you can imagine a 2-parent type of a household. One might be working in Dallas, the other one might be working in Fort Worth. To live in Arlington is sort of like a natural standpoint, because each and every one will have a good 20-minute drive to reach their employment center. And so this area has been growing. There's entertainment centers over there. It's the home of the Dallas Cowboys. There's all sorts of different things that are happening over there, and it sort of like brings both cities, both individuals from both cities to meet in the center. And so it's a very natural point and a very easy access also to the airport and everything else. If we're looking at other growth factors and economic growth, I'm not going to go through this, but the information is available here for you, and you can go through it and you understand what's the dynamic of those markets and why we love to invest in Dallas and why we care. It's obviously diversified, very diversified employment sectors that is not concentrated on one area, maybe like Houston, that's heavily concentrated on energy. Here we have a very, very natural sort of like diversified workforce. You have all the statistics, all the good stuff. It's just a good place to be. In terms of our on-the-ground management, which is extremely important to us, over the course of the last 3 years, we have taken over this project. We removed one management company, replaced another, weren't quite happy with the way that things were going, and eventually we were able to come to terms and bring Devonshire. I think they're wonderful people. As I mentioned earlier in the presentation, we have them in 3 different projects right adjacent to us. We are the nicest project, we are the larger project, and they're just, they've been around for a very long period of time. They're managing close to 1,400 units. And it's quite substantial. So when you have this sort of like, synergy, if there's something missing, if we're buying products, if we're buying things, we're able to buy in bulk. If we need some extra help because we have a bunch of tenants about to moving over this weekend, we can call somebody from the other team, and within a minute or two, they're in our complex helping painting and do all kind of different things. Altogether, they're just wonderful people. They're the best we've had, and we're very, very happy with them. There's a lot of communication. We're very much in the details. Myself and Marika, we travel to Dallas, to the complex quite often, sometimes once a month, sometimes once every couple of months. The team here also travels, and of course we have Kevin, who's sort of like our home buddy in the area. And so we have a lot of eyes on the property and on this project. You have some breakdown of all the other properties that Devonshire manages. As I said, those guys have been around more than 72 different complexes. Our complex is not here. This is kind of like a little bit outdated, but we're the 73rd complex for Devonshire. For those who are new here today and never met with us before at Astor Realty Capital, again, a little bit about who we are. So Astor is obviously a private equity firm. We invest in real estate and exclusively in real estate. We have all sorts of projects that we take on. Some of them are designed to provide our investors growth, large growth equity projects like the project that we're reviewing now. Other projects are designed to create income, where we do distribution of income on a quarterly basis to our investors. As a collective, with all of our executives combined, we have 65 years of real estate experience. I hold 30. I started in 1995. Today, these days, in 2025, that makes it 30 years for me in the business. As a company, we're national. We're investing in 12 different major markets. Our portfolio mark to market is valued over $3 billion. And from to date, we raised $167 million with multiple exits. Our average, which we change on a quarterly basis, depends on what sort of projects we have, what sort of exits we have, average at around 22.3% a year. That is taking all strategies combined, strategies that cause our investors to make above 25 and 28% return, and the strategies that offer them 14%. If you put everything combined, we're around 22%, and as I said, it changes quarterly. Over 3,600 units and 4.7 million square feet to date. More information about myself you can find here, and of course in our website. We're fully staffed. Our individuals have been, many of the individuals that have been with us and principal have been with us for a good number of years, working together, doing good together, and we are spread across the United States, big concentration across Miami and the Northeast, but we also have Alex, who's with us in Washington, D.C., and Laura, who's not on this call, but part of the group here. She's in Denver, Colorado, and then others throughout. That brings us to the end of the presentation. I want to thank you all for participating and for taking the time, and certainly open to any questions you might have. Stick around. let's talk more. Thank you again. Okay, very great. Thank you for that, Alex. So I think the key element here is, the return, which I think is nice, but also the depreciation income. We're going to give some priority for individuals that have been with us. We have multiple exits coming up in 2025, which means that we have some good problems, right? We have to pay some taxes. This essentially, this strategy allows you to place capital, make the capital work in a very nice way, over 21% on an annual basis, but also allows you to take some of the burden of the taxes off. If you don't have exits coming up in 2025, we also have a big peak in 2026 projected. And again, we're going to see with the income that we're generating, we're also going to see a good amount of need for taxes, and so that we create a little bit of a reduction of the tax burden when it comes down to it. I hope you find this presentation appealing, and I hope you find this investment appealing. We're open to you reaching us out, and we can sit down and talk exactly about your projects, your exits. If you're new, there may be different projects that you've been doing with different property, with different management companies, investment companies like us, and see what exactly this project can benefit you in terms both, of course, of the income, which is what we're projecting, but also in terms of the taxable impact. Any questions? We got the team here, anywhere from Sebastian to Kevin, who can talk more about depreciation income. Andrew is in the details, in the legalities and everything else, and of course, Marika and myself. So any questions? I'll give it a minute or two, and before we sum up.
Joe, we do have a couple questions in the Q&A. Saad had asked, can you speak to what's the major contributor to the high projected returns in such a mature project?
Absolutely. So what we're doing is we're recapitalizing the project right now, and we're infusing capital into this project on lower basis. Essentially, this is not a good time to sell. It's a great time to buy. And so we're sort of like recapitalizing the project in order to offer new capital and a reduced basis, the entry into this asset. We see the growth. We see essentially the continued demand in this market. And quite frankly, all of our equity projects are north of 20% return. And those of you who have been with us, we have 38 projects to date. If you focus only on the equity projects, our average return across all strategies is around 22%. Our average return across equity is somewhere in the 26-27% return. I think that this project is no different than many other projects that are being acquired in the right way. And at the same time, another point that probably makes a difference is we don't kill it with the fees, right? This one is different for us because we're signing personally on the loan, we're taking the reins, we're actively managing the day-to-day with our boots on the ground management company, but we're involved in all the day-to-day decisions and all those different things. And so the sponsor here is in fact us, and we're not killing it with the fee. So I think between the fact of recapitalization, the fact that we are, I think, fair with how we're approaching it, essentially we're looking into what I consider to be reasonable returns. Another point to mention is right now the market is suffering through very high interest rates. And so when we are projecting the exits, we're essentially projecting, if you notice, the same 5.75% cap rate across the next 10 years. It's not a secret that in the last 3, 4, 5 years, this type of properties were trading for sub 5% cap rates, and in some instances, even lower than a 4.5% cap rates. And I hate to say it, but in some cases, even worse than that. So there are always peaks in the market, and that's directly correlated to the essentially the interest rate environment, which obviously have an immediate effect so on the valuation and everything else. And so it's the recapitalization, it's the fact that we are stepping into almost completely stabilized property. And basically at this point in time, it's an interest rate game.
And another question from Rizwan. Any potential issues encountered? And he lists a number of CapEx related items. So Joe, maybe you can just talk about, a good amount of money that we've spent on the CapEx thus far.
Well, the biggest issue that we've encountered pretty much from the beginning was issues with plumbing. It's an older property, 1972, my birth year, 53-year-old property. And ultimately, that was, I think, one of the heaviest issue. Everything else is sort of manageable, change the carpet, paint the apartment, put this type of tile, put the other type of tile. Lease up was pretty decent. The demand is the demand is there, right? We're the nicest property and we're pricing it according to very similar to everyone else pretty much on our block and a few blocks over and in the immediate area. However, we got the grounds, we got the greeneries, we got the big pool, we got all this nice open spaces, 2 different laundromats, all the good stuff. The underground was a major issue. We were really suffering with bursting pipes, leaking toilets, you name it. And it's amazing to understand and to see how much money gets sucked away just by water flushing at a non-stop. Ultimately, we brought in a professional company that's what they do. They come into a project and they start fixing those things. They hit the underground issues. They go into all the faucets and all the other nodes that are actually causing those type of leakages. And we basically went into every apartment in the complex and every toilet in the complex, changed the shower heads, changed the toilets, brand new toilets. We have pictures of it was a whole mess. Toilets coming out, new toilets coming in over the course of a number of months. They went into the ground. They started fixing all sorts of old pipes, replacing them, and doing those type of things. And ultimately, we're seeing the results. The other ones, the other areas were, I think we had some issues maybe with some electric and some wiring that we had to address. So it's over the course of the last 3 years, a lot of those things have been addressed. From 205 apartments, I think we've renovated, if not 80% of them, then a good 70+% of those units. And so at this point, it's just a small addition. If a tenant leaves and he left an apartment that is been fairly refreshed and renovated, then the next thing we have to do is maybe clean the carpet, a fresh coat of paint. It's ready to go for the next tenant. So a lot of the heavy stuff has been done. We also had some issues with retaining walls. So we've had to repair that. So that was a bit expensive. Sagging balconies on the second floor. It's a 2 stories. On the second floor, we repaired a good number of sagging balconies that were hit with some water issues and stuff like that. We took care of all of that. In fact, when we took over the property, there was a list from the city of violations. The list that was a never-ending list was of over 400 something violations, anything from very small things to some more major things. And so we literally worked with 2 contractors, one after the other, going through the punch list. There was something that we done pretty early on, and that part of the renovations is over. It's behind us. It's not to say it's an older property. There's always going to be something, an AC unit going bad. We have to fix it or replace it. But this is kind of like an ongoing type of an operation. But the major stuff is really behind us. We replaced the pool. As I mentioned in the video, the pool was green, and it was very sad because, we got young kids, we got families over there. They're passing by the pool in its summer, and it was really sad. So that's something that we've attacked immediately. It's the first thing we wanted to see. So we've changed the entire pool area, took out of course, the water, changed the tiles, organized the entire thing over there. It's sort of like very central in the property, and it looks great now. We're very proud of it. Whenever there's a holiday, we do our holiday parties around the pool, and we do barbecues around the pool, and we do kind of like, we wanted always to create an environment that is very welcoming, very family oriented. And so I believe we've done that very well.
Had a couple of questions from Susan. Actually, I guess you kind of answered one of them live. So the returns without considering bonus depreciation are projected at 21.7%. Yes, that is correct. So any bonus depreciation to offset qualified income would be on top of that. And Joe, maybe just talk about the timeline a little bit, right? Because we are not really, there was a couple questions on this, not really expecting to return any capital prior to 2028, right? So we're going to be in a period of, finishing stabilization, taking out the permanent loan, and then there is some preferred equity. So there is not really any expected distributions for investors until we actually exit the project.
Yes, correct. So what we're relying on you enjoying the depreciation income is sort of the trade-off. There's from our presentation, from our analysis, we're not showing a return. There's not going to be any returns. It's going to be very similar to all the projects that we do, which is development. You put the money in today, we build the asset, we stabilize it, we sell it, and then we do the distributions. We're looking at it from the very same standpoint. The bonus here is, of course, the depreciation income, which obviously helps in taxes. We looked at all sorts of scenarios. We have some scenarios where we return some capital to the investors along the way. But I want to tell you one thing. Over the last 10 years, we've been inundated with various companies that have approached us to invest together with them in various projects. And what we know is that a lot of the expected sort of like along the way type of distributions, whether call it 4%, 5%, 6%, sometimes 8%, never really matured, never really happens. So we much rather approach it as a way is like there's no distributions. You're essentially enjoying a reduction in your taxes, which is obviously very valuable. And then eventually we're all going to distribute capital when we exit from this project. Some of you are new to Astor and the way that we operate and the way that we think. One thing about us, we don't try to play crystal ball. We believe in certain values of the market, and we believe that the values are where we are is, very low point in the market, and that from here it's going to go up. That's what we believe. We don't implement it into our presentation. We're essentially saying keep values where they are today, continue stabilizing the property, continue naturally at a growth of very minimal growth of about 2.5%, increase the rents, increase expenses along the way similarly, obviously except for real estate tax and insurance. Those we ultra hyper accelerate. Whether we're right about this, then we're good. If we're wrong about this and it doesn't accelerate double than all the other expenses, then we're doing better. And then we let the market do what it does. I want to refer to one of the projects. Some of you here have been with us on this project. We had a project in Tampa. In Tampa, we projected a 16-17% annual return after a 3-year hold. And we bought this in kind of like December of 2019. Everybody knows what happened 4 months later. The world stopped and things got sideways. We were holding on to the property, very similar property, Tampa. I think over there we had 114 units. Also, class, blue collar class type of an asset. And then we caught an interesting moment in the market in 2021, end of 2020 into 2021. We started seeing a huge peak in the market. We saw interest rate was extremely low. Buyers were frantic to get into everything that they could. Rents were climbing and everything was just moving the right way. Everyone was in the market looking to buy, and we were like, great, that's our point to sell it. And we sold the property. Many of you have seen returns of north of 45%, some of you even 50% annual return net to you. So there is a point in time in the market. I keep on referring to 10-year market cycles or 12-year market cycles is divided into three smaller major cycles. Each one represents 3 to 4 years type of a period of time. Where we are is in the lower part of that. From that, we see growth. We just have to time the market in such a way that maybe even will outpace the type of return that we're hoping that we're projecting here. So that's we're hoping that will happen, but it doesn't appear in our presentation.
Okay, and then we had another question from our friend Susan. Are you able to accept funds from self-directed IRAs, 401ks, things like that? The answer to that is yes. Although she, kind of posed the second question, do you lose the benefits of depreciation if you invest through a self-directed IRA? So, Kevin, I'm not sure if you're with us now and if you're able to answer that a little bit, but certainly we are able to accept from self-directed IRAs, the on-trust groups, equity trusts, IRA clubs of the world. We have existing relationships with all of them. But that's a good question, Kevin. Do you think you would lose the depreciation benefit if you invested through that?
Yeah, that is something that you would want to speak to IRA, but in most cases, in my understanding, when you are investing out of like a retirement account and all, you typically won't be able to take advantage of depreciation. So typically, I advise my investors that if they are looking to take advantage of depreciation, they should do it outside retirement account. Because already if your retirement account is tax deferred, you really can't double tax defer it, okay? And you're not really going to be able to take advantage of the offsetting elements of depreciation. So, but certainly I would speak to your custodian, but in most cases, it is not advised to use a IRA account.
I tend to side with Kevin on this answer. Susan, first of all, congratulations on your sale, and I'm happy you're using the self-directed IRA. We do get a lot of our investors from self-directed, mainly the larger company have been endorsing us for the last several years on multiple projects. And I also think that because you're coming through a structure that is tax deferred by itself in nature, right? It's in the retirement account. So when we generate income, you don't pay taxes, right? The money goes back. I don't think that you'll enjoy the depreciation income. Having said that, we're gonna reach out to our tax attorney to find out. But I'm kind of like on high level. I think that Kevin is absolutely right on it.
Okay. We had a question from Hiram. What are the possible events that could occur that would cause returns to be either very minimal, sub 10% or lower, or even generate a loss?
As real estate investors, we take our money out of the safety of our money markets where we're making 4% into the world of hyper returns, but with it comes some risk. Here's what I can say. If we feel that the market is not there for us, we're not going to sell. The worst of this property is behind us. The tough days of 2023, where interest rate jumped 9 consecutive times in a row, are behind us. Fundamentals are stronger right now. Inflation is under control. But you name it, right? You can come up with any number of scenarios where the world can go upside down and things can go so bad. Well, our aim at this stage is to finish stabilizing the property. We're almost there. Finish stabilizing the property. Take a long-term mortgage, fix the interest rate, put a lid on it, let the property work itself out, and let the market return. If we don't think the market will return in 3 years, 4 years, 5 years, 6 years, we're going to hold the property. We're not going to sell it at a loss. We don't believe in losses. We've been doing well, to some, I would even say very well, in considering all things in the last 5 years, from pandemic to inflation to supply chain issues and certainly to interest rates. So I think that based on all professionals and all accounts, we're looking into a stable environment. And essentially, we're a stable property today, right? So I can tell you that the other side of that conversation, it may go longer. If we feel that the market took a dip for whatever reason, we're fairly occupied, we're renovated, our rents is good, we're not aggressive, we're competitive with everybody else. So, we'll stay longer. That's a scenario that could happen, it could happen. We don't have losses. We don't allow losses. We do whatever it takes. We do whatever it takes to keep the property. But, we can always sit here and imagine, what if North Korea, or what if I don't know, right? We don't know those things. There's some element of risk. This is why we keep on saying, create yourself a diversified portfolio, have money in the stock market, to have liquidity, have money in bonds, have money in the bank, and have money in real estate, and allow it to grow. Don't put all your eggs in one basket. And that's essentially what I can recommend. The returns that we're showing and we're consistently been showing, ultimately, we have no losses. None of our projects have shown any loss to any investor. And some of them hit the ball out of the park, and our investors have done better than 30% annual return on some projects, and some have been lukewarm. It can happen. But I will say this: preservation of capital is the most important thing for us, and I'll do whatever it takes to preserve your capital. We're signing personally on a loan. We're rolled our sleeves. We're taking whatever steps necessary to maintain this property and to bring it up to a certain point in time in the market where we can sell it and we can return capital and make profits.
Thank you. And then Hiram also just had a follow-up. What is the leverage of the property now versus the current market value?
So that's a great question. What's the leverage? The leverage is basically, what do you think the value of the property is? To be quite frank, I think that if I would have to sell the property today, I'd like to sell it for around $30 million. I don't think that the market will allow me $30 million. But it's really a function of, what's the valuation of the property in order to see what's the loan to value. I will say this: HUD has given us a proposal of $24.3 million at a reasonable interest rate, 5.5%. We have to go through the next 6 months of stabilization in order to take it. I'm not sure we'll take it, but that's one option. We have another option from agencies at 5.3%, and that's a little bit lower. That's essentially around $22 million. So the bank is looking at our numbers. The bank is not saying what the value is, but the bank is saying, based on your coverage, I can either get you into 24 million, 22 million, and that's sort of like the interest rate. Interest rate will come down in the next year. Those loans will go up, right? Interest rate will come down. Those loans will go up a little bit. An extra million here, an extra million there. We're not assuming that. We're assuming that interest rate will stay the same. We're not taking a stand that interest rate will drop, even though the Feds have been saying it, and the environment shows that it's going to go there. I really can't say exactly what the value is. I can tell you that, in my opinion, upper 20s into a $30 million. the market will not allow it to happen today. And so that's where the opportunity is for the new capital. And that's essentially where we as managers are looking to do the right thing. Those that are selling today are selling because they have no choice. They're selling because they ran out of liquidity, or they're selling because they're no longer interested to manage the property for long term. That is not our conversation.
Okay, perfect. We have one more from Irv Braun. He had invested in the original deal, was wondering what the projected return was then. What do we foresee it to be in 2028? And how can he benefit from the bonus depreciation?
So everyone's getting bonus depreciation. That's something that we'll share across to all investors. And essentially, I'm not quite sure what sort of returns we're able to offer the initial investors. But the depreciation is there. And the focus here is the new capital that's coming in, and sort of like where it falls, where it sits within the capital stack.
So there's no more active questions, and we're just at about 7 here. So I don't know if maybe you want to wrap up, Joe. And if anyone has, I will say right, obviously, if you have any other questions, we are available. Joe, Marika, Alex, myself, Kevin, Sebastian, email, phone. I think we'll send around a recording of the webinar. So we're fully available to answer any questions, discuss anything. Yeah, go ahead, Joe, if you wanted to maybe wrap up.
Yeah. So again, I think that if you want to understand better about bonus depreciation and about the benefits that depreciation income is gonna do for you and for your portfolio, as I mentioned, we have a lot of our investors with exits in 2025. There's a 43% depreciation bonus that's happening for this year, so that can beautifully offset a lot of that capital that needs to go out to the IRS. So that's the first thing. We can have a discussion about it. Reach any one of us, either email, phone call, and then we'll get on a call where we'll discuss. We'll do a short analysis to see what's the benefit of this project for you. And I hope you'll come in with us on this project as well. I think it's a good project. At this point, as I mentioned, the worst is behind us. And, we have folks that came in with us on the preferred equity. The preferred equity is doing really well. There's been a crimp down on the existing equity, and that's our aim is to continue pushing forward so that at the one point in time where we actually exiting the property, everybody's going to get their capital. New capital is obviously going to be making more. The older capital is going to be making less, but there's not going to be any losses. That's essentially our structure in this project. So any questions that you have, reach us. We're happy to get on a call, and we're happy to do another deal together. Thank you very much, all of you, for joining and for the time. And I'm looking forward to talking to you on a one-on-one basis. Take care and have a good night.